Debt down, gross block up. 4 listed companies quietly compounding wealth. Disclaimer, read first. I am not a SEBI-registered analyst. This discussion is purely educational and should not be considered investment advice. Please do your own research or consult a financial advisor before making any investment decisions. The big idea. Did you know? Just 4 listed companies in India are ticking 3 rare but powerful boxes at the same time. Slashing debt steadily compared to 3 years ago. Supercharging gross block, 2x bust year on year. Market cap Rs 500 crore, attracting institutional interest. When these 3 signals converge, it often points towards businesses that are not only strengthening balance sheets but also aggressively expanding capacity for the future. Think about it. Debt reduction equals lower interest outflow, stronger profits, and healthier cash flows. Gross block growth equals higher capacity plus new technology, leading to higher future revenue potential. Healthy market cap equals liquidity plus visibility, more eyes from large investors. This combination, if sustained, can be a recipe for long-term wealth compounding. The hand-picked list. Based on a custom screener.in filter, here are the 4 companies currently shining under this theme. 1. Inox India, known for its cryogenic engineering products. Debt has been trending down consistently. Gross block has seen healthy growth with expansion into new product lines. Plays into energy transition plus LNG infrastructure growth. Why it excites investors? Niche player, capex cycle aligned with India's push toward clean energy and industrial gas infrastructure. 2. CG Power and Industrial Solutions, once debt-heavy, now much leaner with steady deleveraging. Significant expansion in manufacturing base transformers, switchgears, motors, benefiting from PLI schemes and power sector modernization. Why it excites investors? Clear turnaround story plus industrial demand upcycle. 3. NetWeb Technologies, a new-age high-performance computing, HPC, and AI-focused tech hardware firm. Strong increase in gross block as it scales manufacturing capabilities. Debt-light model, focusing on reinvestment and R&D. Why it excites investors? Riding the global AI plus data center boom, with Make in India tailwinds. 4. Trent, Tata Group, retail growth story, Zara JV, Westside and Zudio expansion. Consistently trimming debt while investing heavily in new stores and supply chain. One of the fastest growing listed retail names in India. Why it excites investors? Strong brand plus aggressive retail footprint plus Tata backing equals long runway for growth. Why this combo matters? 1. Debt reduction. Lower debt, reduced financial risk, frees up cash flows, reinvestment, dividends or buybacks. Signals management discipline and sustainable growth focus. 2. Rising gross block. Gross block equals total fixed assets, factories, machinery, infra. When this grows faster than liabilities, it signals capacity-led growth, higher future revenue plus better margins when scale kicks in. 3. Market cap threshold, Rs 500 CR, ensures companies aren't tiny illiquid bets. Institutional investors start paying attention. Improves governance standards and valuation stability. Put together, these metrics can identify scalable, resilient businesses with both short-term financial stability and long-term growth capacity. The investor's dilemma. Now let's ask the tough questions. Debt reduction versus capex expansion, which matters more? Debt reduction ensures safety, especially in cyclical or interest rate sensitive sectors. Capex expansion drives future earnings growth but requires upfront investment. The sweet spot? Companies that manage both simultaneously, like the 4 above. Should valuation filters matter? Absolutely. PE, EV/EBITDA, ROCE, ROE, all help decide whether growth is already priced in. A great business at a very expensive price can still disappoint. When to enter, now or later? Momentum investors may prefer entering during the growth wave. Value-conscious investors may wait for market corrections. Strategy depends on your horizon. 3 years versus 10 years makes a big difference. Key takeaways. Companies cutting debt while growing gross block are positioning for sustainable wealth creation. Inox India, CG Power, NetWeb Tech and Trent are current examples of this theme. Investors should weigh valuation, sector cycle, and entry timing carefully. No single metric works in isolation. It's about connecting debt, capex, growth runway, and pricing together. Over to you. Which of these 4 companies do you find the most compelling and why? Do you believe debt reduction or capex expansion is the bigger driver of long-term wealth creation? Would you wait for better entry points or ride the current momentum? Drop your thoughts in the comments. Let's get a meaningful discussion going. Final disclaimer. Once again, this is not investment advice. I am not a SEBI-registered analyst. These are purely educational insights meant to encourage independent thinking and research. Please consult your advisor before making investment decisions.